I want to discuss sustainable growth. So the question is, how fast should a firm grow? So your first thought is probably, well, I have a firm, I'd like it to grow as fast as possible. Well, the problem is that the faster a firm grows, the more resources it needs. Growing faster than what we're going to define as the sustainable rate means needing additional cash to support the growth. On the other hand, if a firm is growing slower than the sustainable rate, they're going to need less resources and they're going to have a surplus of cash. So let's think about this. Suppose you own a Domino's pizza franchise. You're at the sustainable growth rate. Then the resources you have support your business. Now suppose you start selling a lot more pizzas. Maybe they build a housing development close to where you are, and a lot of those people want to buy pizzas from you. Now all of a sudden, one delivery car isn't going to be enough. You may need two. Maybe you'll need three. One driver and delivery person isn't going to be enough. You might need two or three. You're going to have to buy more flour, more cheese, more other inputs into making these pizzas. So it's going to require additional cash. So how do we define the sustainable growth rate? A company's sustainable growth rate is the maximum rate at which it can grow without depleting financial resources. The sustainable growth rate is based on the assumption that management will not sell new equity and will maintain a constant debt ratio. So as the company earns money, they can add some to retained earnings, and they will be willing to issue debt just to maintain that constant debt ratio. So the sustainable growth rate limits the rate at which this company can increase sales, or more generally, its overall expansion. If the firm doesn't want to issue equity, it's the ratio of the change in equity to the equity at the beginning of the period. So let's take a look at this equation here. So G star is our sustainable growth rate, the change in equity over equity at the beginning of the period. What is the change in equity? It's retained earnings. It's how much money the company has earned and added to retained earnings. We can further decompose retained earnings into R times earnings, where R is the retention ratio. The retention ratio is 1 minus the payout ratio. The payout ratio is the percentage of earnings that are paid out in the form of dividends. So if the payout ratio is, let's say, 30%, for every dollar the company earns, they're going to pay out 30 cents in dividends, and they're going to retain, or they're going to add to retained earnings, 70 cents. Now, we can decompose ROE to get a better understanding of the factors that drive this sustainable growth rate. And we can do that by using the DuPont equation, named for the chemical company that pioneered this approach. So first we're going to decompose it into ROA and a measure of financial leverage. So the equation for ROE, or return on equity, is earnings over equity. The equation for return on assets is earnings over assets. If we multiply by something we call the equity multiplier, it's assets over equity, we get earnings over assets times assets over equity equals earnings over equity. So we've multiplied this by this, right? And you can see that assets cancel, earnings cancel, and we have earnings over equity. So we haven't really changed anything. But why did we do that? Because it gives us a way to understand sustainable growth a little bit better. So what drives sustainable growth? 3 factors here. The retention ratio, so how much of earnings do we put into retained earnings? The equity multiplier, which is a measure of financial leverage, and our return on assets. Let's decompose this even further. So again, we have earnings over equity, and we're going to play this little mathematical trick. We're going to multiply by 1 and rearrange terms. So we're going to multiply and divide by sales over sales. Sales over sales is just 1, so we're not changing anything, but then we just rearrange the terms. So we get earnings over sales times sales over equity, and you can see these cancel, so we still have earnings over equity. We haven't changed anything. What's earnings over sales? It's profit margin. What's sales over equity? It's what we call equity turnover. It tells us how much sales we generate for every dollar in equity we have. We're going to play this game again. We're going to multiply and divide by assets and rearrange the terms. So what we're going to get here is earnings over sales, sales over assets, and assets over equity. And again, you can see that sales cancel and assets cancel, so we still have earnings over equity. Why did we do that? Because by decomposing it this way, we can see that return on equity can be broken down into 3 factors here. Profit margin, which is earnings over sales. Asset turnover, which is sales over assets. It's a measure of efficiency. How much sales are you generating for each dollar you have in assets? And then assets over equity is what we call the equity multiplier, and it's a measure of financial leverage. So the sustainable growth rate is the product of 4 factors: the retention ratio, profit margin, asset turnover, and financial leverage. So let's think about this. If a firm is growing faster than the sustainable rate, it's going to have cash deficits. What can it do to improve its prospects here? It can increase the retention ratio. Okay, this can be difficult because when you're talking about a young company that's growing very quickly, they may not pay a dividend at all. So R may be 100%. That is, the payout ratio is 0. They can try and increase profit margin. Okay, again, this is going to raise the sustainable rate so that it'll catch up with the rate at which the company is actually growing. Okay, everybody would like to improve their profit margin. That may be difficult. Asset turnover is a measure of efficiency. Okay, again, you'd like to be more efficient. You'd like to use your assets more efficiently to generate sales. If you can do that, that's good, but you may not be able to. But if you can't change those first 3, your last choice is you have to increase financial leverage. Okay, so you're going to have to borrow more money. Let's take a look at the flip side. If a firm is growing slower than the sustainable rate, it's going to have a surplus of cash, so it would like to reduce its sustainable rate. Well, what can it do? It can decrease the retention ratio. Okay, that is, it can pay a higher dividend. That's actually pretty easy to do. Again, profit margin, asset turnover may be difficult to change, but they can also reduce the amount of leverage that they use. So you can see that, when a company is growing too fast or too slow, there may be a problem. Too fast, you're going to need other financial resources. Too slow, you're going to have a surplus of cash. This is why you see older or more mature companies paying a dividend, right? Because they have a surplus of cash. And in many cases, you'll find them reducing their financial leverage. They may, they may choose to retire debt in order to reduce that, the amount of leverage that they're using. So I hope you found this useful, and thanks for watching.